Hello friends, Namaskar. Welcome back to my channel all of you. Today let's discuss about the investor irrationality insights from behavioral finance, friends. Normally we discuss the things in traditional finance like investors think and behave rationally, and that means whatever they are expecting they will get it. But in reality their investment decision would be influenced by psychological and the sociological factor, friends. So in based on this background, look at this picture also. Like sometime as an investor, when we lose our investment, we are supposed to be panic. But my point is that sometime as an investor, we should have a patience too towards our investment strategy. We should not be panic. And second picture you could see that is the loss aversion. That means why do we panic when market falls, but stay calm when they rise? So based on this background, let's move to the discussion. First of all, it's the background of today's discussion, friends. So this is all about your traditional finance. That's talk about starting from the arbitrage pricing theory, then which discussed by the Miller and Modigliani. Then portfolio theory, that's Markowitz in 1952 discussed about the how we could optimize our returns at the minimum risk level. And again, capitalistic pricing model, that is the SARP, which talks about simply like your expect required rate of return, your expected return would be equals to like your risk-free rate plus market risk premium into beta value, beta coefficient, which is the measure of systematic risk. While random walk theory, Farmer discussed in 1965, that's all about is based on the efficient market hypothesis. Now let's talk about your option pricing theory. That's all about your Black-Scholes, Morton. 1973 he discussed about the real option analysis like that. Agency theory we talks about the like your relationship between like your managers and the shareholders. Similarly, managers and the stockholder, there will be the what type of agency cost would be there. So that is all about the Jensen and the Maclean in 1976 is discussed. So based on traditional finance, friends, this is all about investor think and behave rationally, as I discussed earlier, and accordingly they form the rational expectation from their uh, for their investments. So stock, when we say that market efficient, efficient market, so stock price follow a random walk as discussed by Pharma, who is the father of modern finance. So that is the change in the stock price equals to, that's the error term we say that. So there is no any abnormal return. So this is all about RT, that is the actual return minus expected return is the zero. But in reality, because of the market anomalies, because of market imperfection, friends, there will be abnormal return because of, for example, some news announcement, merger acquisition announcement, stock split announcement, stock repurchase announcement, whatever the announcement, there would affect the stock prices. But that is the case of abnormal return, friends. But as for market efficient, we say that no abnormal return, friends. So now let's talk about what about the case of now behavioral finance. So behavioral finance, friends, so we can say that this is the field of finance, no doubt, but it assumes that the market is not efficient. It talks about the inefficient market, irrationality, cognitive and the emotional biases, because of which investors will not behave rationally. So influence of psychology and emotions on the decision making process, as discussed by the Daniel, who won the Nobel Prize in Economics in 2002. So common emotions in human beings, we say that that's a greed. So desire for wealth, we say that, and the fear is all about unpleasant emotions. Thought caused by we say that threat of pain. So misinformed by the extreme of emotions. One. Second point, that is the you need to understand that is a subjective thinking, and the whims of the crowd, that is the hard behavior. We say that in finance, and that's a behavioral finance. We say that. Okay. Now let's talk about what about the case of again why people make irrational investment decision then. So this is all about, look at your, this is the finance that we are talking about, traditional finance from which behavioral finance comes, and the behavioral finance subject which area of psychology, yeah, sociology would affect our uh, is the domain of behavioral finance, we say that, under which we say that cognitive psychology, how people think. Next, limits to arbitrage, when market will be inefficient, like that. Okay. Now let's talk about the one of the is the important contributions in the behavioral finance area. That is the prospect theory value functions, which is simply the pillar of behavioral finance, friends. And the decisions, we talk about the under risks and the uncertainty. So there are the two steps or phases in decision process. One is framing, we say that. That means, like as an investor, what do we do? Like outcomes of the decision are ordered according to certain heuristics, which is simply mental shortcuts or quick thinking patterns. And the next one is that's the evaluation. People behave as they would compute a value, yeah, utility based on the potential outcomes and their respective probabilities. If you believe that, yeah, let's say that you believe that you are going to invest in the mutual funds, but even though we know that mutual fund is subject to market risks, so we can't say that there is a certain that your investment will have a 10% return like that. There will be probability. Probability means you are not certain that. Chance would be there. So, and accordingly, you choose the alternative having the higher utility, friends. So that means when you expect the more returns, then you would be parking your money more in that area. That is the part of your, is all about your framing and the evaluation process, we say that. So let's talk about what about this value function then. So as an investor, normally what we do when when we have a loss, we say that we react more than that of having the capital gain, we say that. So when we have a positive return, we react less as compared to negative return, friends. So this is all about losses are overweight while gains are underweight. Okay. So that means the risk aversion means losses hurt more than gains feel good. So this is S-shaped value functions. So risk averse for gains, that is the concave functions. Yeah, risk seeking for the losses, that is the convex function, we say that. And next point you need to understand here, that is the friends reference point, which is all about your today wealth, yeah, subject to manipulations. Suppose you have purchased the stock at per stock at 2000s 2 years back. Are you going to sell your stock? Probably no, friend, because you might attach with that reference point. So in that case, but actual point is that stock might be falling down, but still you try to hold your stock. That is the problem of investment strategy, we say that. So I believe that whatever I discussed today in the area of your behavioral finance, by understanding the traditional finance, we could link the concept. Then you could do the research in the area of behavioral finance too, friends. I believe that whatever I discussed today, that would really uh, clarify your discussions. Yeah, whatever I mean to say that about your behavioral finance, that will enrich your understanding level, friends. If you really like this content, please like, subscribe, and also share my channel, that is the Finance Guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.